In today's lesson, we'll be going over 3.4 final accounts. Now, first off, we have to look at how final accounts may be useful and why stakeholders might be interested in them. Essentially, the final accounts, by the way, are the jobs of the accountants. They're meant to give stakeholders an idea of the company's financial position at the end of a calendar year or of a quarter. So, why might people be interested in them? Managers might use them in order to measure performance, compare them to competitors, and help with decision making and goal setting. Employees might look at them in order to understand the security of their jobs, and they can be used for contract negotiation. Obviously, if a company does well, they can negotiate for a better contract. And shareholders obviously use it to understand the profitability and growth opportunities of the company, whereas financiers decide whether to lend money to a company or not, and suppliers decide whether to provide trade credit or not. As well as that, government obviously has to do their taxes and has to check that they're abiding the laws. And they actually do care about it because they want to see how many job opportunities this company might create for the economy. Lastly, competitors also, they compare their own performance through the financial accounts, and they look at how they can improve maybe their performance themselves. So, there's two types of financial accounts. The first is the statement of profit or loss. This essentially just tells you whether the company has gained money or lost money throughout the year. Its format is, as you can see on the screen right now, that being, do not forget your phrase, which is statement of profit or loss for a specific business as of the date and time. Then you will write down sales revenue and its dollar amount. Cost of sales, which is opening stock plus purchases minus the closing stock. Then you have gross profit. After that comes expenses. Then there's profit before interest and tax. Then there's interest. There's profit before tax. There's profit before period. And then the last section is dividends and retained profit. So those two, they need to add up to the profit for period, and that way you will know that you've done this well and accurately. For non-profits, however, the word profit might be replaced by surplus rather than profit. The second type of financial accounts that we have are balance sheets. Now, the balance sheet shows the value of the assets and the liabilities of a business. An asset is a possession of a business, whereas a liability is essentially the business's debts. The format, once again, do not forget, but this time write statement of financial position for the business as of the date. Then we start non-current assets, so that is all the big assets, let's say buildings, cars, whatever it may be. As well as that, there might be some depreciation accounted for in there. You have total non-current assets. Then you have current assets, which are cash, debtors, and stock. Those are the only ones that count as current. You have total current assets. And then you have total assets. So just add current and non-current together. Whereas we go the opposite way around for liabilities. So we go current liabilities first, total current liabilities, non-current liabilities, total, and then we have the full total liabilities. Then, after we have total current assets and total liabilities, we do assets minus liabilities in order to get net assets. And once again, after that, we have equity, which is share capital, retained earnings, and the total equity must equal the net assets. Once again, that is essential to make sure that you've done everything correctly. Now, as I mentioned, in the balance sheet, you might account for depreciation. Depreciation is the fall in value of an asset over time. there's two ways of calculating depreciation. There's the straight line method, which is when an item falls by the same value every year. Let's say a car bought for 30k has a 5-year lifespan. That means that it depreciates by 6,000 every year. Whereas the second method is units of production. So let's say machinery or things like that, they might lose value per unit that they produce. So for example, to calculate this, you do the cost of asset minus the salvaged value that you'd get once the machine is basically broken down, and then you divide that by the estimated units that can be produced by the machine itself. That shows you the amount the actual machinery depreciates per unit. And then furthermore, you can just times that by the amount of units produced, and that way you will get you will essentially get your depreciation value. Next up, we have intellectual property, and intangible assets. So we talked about these slightly before, but they're the type of fixed assets which are non-physical, but they still add monetary value to the business itself. And they're protected by intellectual property rights. And these can be goodwill, which is the reputation networks of an organization, and it involves the devotion of the employees. So it's essentially the networking that you build. You have patents, which is the right for an invention for a limited period of time. And this gives incentive because it prohibits rivals from copying these innovations. You have copyrights, which are the legal rights to creative work. This is usually done for musicians and authors. It obviously depends on what industry you're in. And lastly, you have trademarks, which are the legal and exclusive commercial use of the brand, logos, or slogans. They basically provide the company with legal rights over their branding. That's it. That's it for Unit 3.4. The main thing you must remember is the formatting of the two final accounts. Thank you very much.